In today's video, I'm going to be going through the top 5 stocks that you can buy in March of 2022. I've gone through and researched dozens of different stocks so you don't have to. I believe these stocks are solid buys right now. For each stock, I will be breaking down why I believe they are strong buys in March of 2022. In this series, I'll be breaking down my favorite 5 stocks to buy in these categories. The first one will be my favorite long-term potential stock. The second one will be my favorite value stock. The third one will be my favorite growth stock. The fourth one, favorite dividend stock. And the fifth one will be my favorite ETF. For those of you that don't know me, I'm an entrepreneur, investor, and we own real estate over 50 plus rental units. I've been investing for over 8 years and became a millionaire by the age of 28. All the information that I give out is free on this channel. And the goal for this channel is to help you achieve financial freedom. So let's get into it. When evaluating a stock, I like to look at these key metrics. You can take a screenshot of this. This isn't the end all be all, and there are a lot more than this, but these are just good starting points that I like to look at when evaluating a company. I won't go into every single one for each stock. I'm just going to point out the ones that stand out, good or bad. So my pick for the best long-term potential stock is NVIDIA. NVIDIA specializes in programmable graphics processor technologies. These are used in everything from the electronic games to personal computers and even the automotive market. They invented GPU that was designed to expand the capabilities of computers and game consoles for improved graphics. If we took a look at their current price is $253.84. Here's a look at their 1-year price chart. We've had consistent growth until just recently, but the trajectory looks good. Their return on assets is a very strong 23.6%. I typically look for 5% or higher. It's how efficient a company's management is at using assets to generate earnings. The quick ratio is a decent 6.5. They're also sitting on a good amount of cash at $19.3 billion. I also like to take a look at the analyst rating. Currently it's at $250, but analysts believe it should be around $341.20. The current recommendation from analysts is that they believe the stock is a buy. So let's take a look at the market news now. They are rapidly expanding into fields such as AI. They sell GPUs for gaming and professional applications, as well as chip systems for use in vehicles, robotics, and other tools. They were trading for over $800 per share prior to the stock split. After the split, it brought the single share down by 75%, bringing it down to about $200 per share, making it more affordable. They are continuing to innovate, and Tesla also utilizing NVIDIA's A100 GPUs to power their autopilot and FSD. This is a stock that has potential for even more growth. There are an estimated 3 billion people playing video games. With NVIDIA being the leading technology supplier, they're continuing to expand in this market. They're also building out its own cloud gaming service called GeForce Now. They also struck a deal with EA to bring Battlefield to GeForce Now. And the crazy thing is, their gaming sector isn't even their biggest revenue generator. Their data center sales increased 55% to $2.9 billion. And of course, they are ahead of the game when it comes to the metaverse. They're already building out virtual simulations and robotic applications. They're really smart for letting its real-time 3D design and simulation tools free to artists and designers to create demand. Now, it won't always be free. They're looking to charge an annual licensing fee of $1,000 per user. Once it's more adopted, analysts are predicting that they could exceed $100 billion per year in this sector alone. I'm super bullish on NVIDIA. I have a Tesla with full self-driving, and I can definitely see the potential as it continues to get better. The GPU cluster is part of Tesla's vertically integrated autonomous driving approach. This uses more than 1 million cars, mine included, to gather data and refine and build new features. My pick for the best value stock is Upwork. Upwork is a tech play that's focused on connecting contractors and those in need of contract work in the gig economy. The gig economy is essentially the prevalence of short-term contracts or freelance work as opposed to permanent jobs. In 2020, the gig economy grew by 33%, expanding more than 8 times faster than the US economy as a whole. You might have even used Upwork to hire out someone to do a graphic, edit a video, or even write articles. Now let's look at their key metrics. Upwork is currently trading for $26.30. You can also see the past 1-year price chart. As you can see, it's trending downward. We'll go into why I'm still bullish on this stock later in the video. I like what I see with their quick ratio being at 3.9. Again, the quick ratio is the ability to pay current liabilities without selling inventory or more financing. Now, I'll admit that their financials aren't the cleanest, but they're sitting on a decent amount of cash of $696 million. I do like what I'm seeing with their quarterly revenue growth at 32.4% year over year. Most analyst price targets are around $55.40, so there's still room to nearly double. Now let's take a look at the latest market news. The gig economy was already big even before the pandemic. However, the pandemic really put rocket fuel on it, and the consumers who were wanting to work from home were able to do so, and the gig economy boomed. Lots of non-essential workers were laid off or businesses were closed. And when the unemployment levels hit an all-time high, these workers started to go to sites like Upwork to look for work. In fact, there have been reports that remote work is more effective, and that most of these companies won't be bringing employees back to the office, according to CNN. Now, analysts are bullish on this stock because work from home seems to be a trend that will continue. While I highly suggest not just blindly following what hedge funds are buying, at the end of September, a total of 35 hedge funds held long positions on this stock. The all-time previous high was at 34, so take that for what it's worth. My favorite growth stock is Zoom. Zoom is a cloud-based video conferencing service when you can virtually meet with friends, coworkers, etc. If you have worked from home at all in the past couple of years, you probably used it. Now you might be thinking it's kind of wild that I'm including Zoom as my pick for high growth in 2022. It was essentially Wall Street's poster child in 2020 when we were in the heart of the pandemic. Zoom investors saw a return of 396% for 2020. However, even after a strong 2021, Zoom is still at the forefront of the digital communication field. Now let's dig into their numbers. Zoom is currently trading at $157.23. As you can see, Zoom has had a huge 52-week range, a low of $156 and a high of $451.77. The one-year price chart has taken a nosedive over the past year, but like Upwork, I'll talk about why I'm still bullish on them and why it's a great time to buy. Now the PEG ratio could be better, but it's not terrible at 3.08. Also, along with the price to book ratio, I typically look for 3 or lower, but Zoom is currently at 9.14. They do have a really strong 18% on their return on assets. They also have a really good current ratio at 3.6. The current ratio is their ability to pay back short-term obligations within 1 year. Their quick ratio is also good at 3.6. Let's take a look at their profit margin. Like most software companies, their profit margin is high at 29%. Taking a look at their balance sheet, their cash flow is positive, which is a good sign as well. Analyst price target is at $305, so there's growth to nearly double. With more variants continuing to come at us, Zoom's growth prospects continue to increase. More and more companies rely on Zoom to conduct their daily business. Even prior to the pandemic, Zoom full-year revenue was up 118% year over year, and 88% in January of 2020. Obviously, the stock took off during the pandemic, but it's since leveled out as bears think it was a pandemic stock and the bulls see the growth rate slowing. As we touched on Upwork stock, remote work isn't going away. In fact, a September 2021 poll from Gallup found that 45% of the US workforce was still working from home, and a majority wanted to keep it that way. They also have 2 other products that seem promising, Zoom Phone and Zoom Rooms. These are huge opportunities of growth for them. As of September, only 4% and 5% of Zoom customers had purchased Zoom Phone and Zoom Rooms. But as employers look to move back to the office, there's a huge opportunity and market share to grow into. You're already starting to see it with Zoom Phone, which had a triple-digit % growth in Q3. And this is going to contribute heavily to the growth of Zoom in 2022. And here are some of the accolades that they've received since introducing Zoom Phone. Now let's talk about my favorite dividend stock for March, which is Target. Target, as you may already know, is a nationwide retailer with close to 2,000 stores. It literally has almost everything you need from groceries, apparel, to home decor. It's definitely one of the best and well-known one-stop shop for consumers. And honestly, I think my wife single-handedly helped keep them in business during the pandemic. Anyway, let's take a look at their financials. They're currently trading at $223.84. Target's 52-week range is $166 to $268. Their current dividend yield is 1.64%. But that's not the reason that this is my favorite dividend stock of March of 2022, and I'll explain why later on in this breakdown. Target's PEG ratio is a very healthy 1.18. Target's return on equity is very strong at 46.7%. And again, the ROE is how efficient a company is at generating profits. Their debt to equity is good as well at 0.92. In the income statement, their quarterly earnings growth has been big, likely due to the pandemic boosting that. Taking a look at their balance sheet, they're sitting on a decent amount of cash of $5.77 billion. It's currently a buy according to analysts. There's still some room for growth as it's currently sitting near the bottom. Target thrived during the pandemic because they were able to adapt seamlessly to online shopping, and because of their huge faithful customer base. They ended last year with more than $15 billion in sales growth, which was more than their previous 11 years combined. With inflation reported at 7% in December, investors are looking to get into companies with real products and revenue. StockNews.com did a head-to-head case study of Amazon versus Target. They did this to see which one was the better buy in 2022. They went through their profitability, valuation, their power ratings, etc. They deemed Target to be the winner based on its robust financials, lower valuation, and high profitability, and better growth prospects like we touched on when we dug into their financials. My favorite ETF from March of 2022 is QQQ. For those of you that don't know what an ETF is, it's also known as an exchange-traded fund. It's essentially a basket of stocks you can make in one transaction. They offer low expense ratios and fewer broker commissions. QQQ is currently trading for $366.48. Their net assets are a strong $215 billion. The annual expense ratio on ETFs are generally low, and same thing goes for QQQ. Lots of people ask me, what are the pros and cons of ETFs? Some say that it's too good to be true. So let's get into the pros and cons. The pros of ETFs is that you can diversify risk, you have targeted industries, low expense ratios, and you can have access to many stocks across different industries. Now let's get into the cons of ETFs. There's typically less high growth. It also moves with the stock market, so this can be good or bad. And the dividend yields are much lower. QQQ is also known as the Invesco Triple Q Trust. This puts the 100 most important NASDAQ stocks in your portfolio in one trade. The reason I like Triple Q is it focuses your portfolio on companies in faster growing sectors like tech. QQQ is the 5th most popular ETF in the world. It isn't super broad like SPY. It's heavily focused in the tech sector, so it has potential for high growth. Some of the companies that it holds is Microsoft, Apple, Amazon, and Google. These are the top 10 holdings in QQQ, and here are the top sectors. You can also see that the past 3 years has also been very consistent. I also like to zoom out to see how it did throughout history. Obviously, it's not an indicator for the future, but it's good to get an idea nonetheless. You can also see the past year's performance. Again, the trajectory has steadily increased. When it comes to ETFs, since they typically have a pretty consistent growth trajectory, I like to dollar cost average into them. Here's an example of dollar cost averaging. Let's say over the course of the next 4 months, you're going to dollar cost average into investment ETF A. As ETF prices do, they fluctuate, and even more so in a volatile market. After 4 months, your total price per share would come out to $43.75, and you'll own 253.5 shares. On the flip side, if you had just bought all those shares in month 1 at $50 per share, you'd only own 200 shares. So there you have it. Those are my 5 favorite stocks and ETFs from March of 2022. I'm going to leave in the description free stocks that you can buy using my favorite stock trading platform. It's with Moomoo, and for a limited time, they're giving away 3 free stocks when you deposit at least $1. Honestly, this is one of the best stock promos that I've ever seen, so go check it out. I'm a firm believer in buying and holding for the long term. There will always be ebbs and flows in the market, but these companies and ETFs that I've listed are companies I believe that have great potential, not only for the short term, but also the long term. Let my analysis be a starting point for you to do your own research before jumping in and buying any of these. I'm not a financial advisor, and this is not financial advice. If you found this video helpful, please give it a like and subscribe, as I'm posting 1 new video a week. I'll be touching on everything related to business, finance, and investing. So if you want to become financially free, make sure you subscribe. Thanks, and we'll see you next time.